Germany's Frankfurt, AP, on Thursday, the European Central Bank slightly reduced its record rate of interest rate increases, joining the US Federal Reserve and other central banks around the world in stepping up their fight against inflation while also making progress in reducing the high prices that are burdening consumers. In a flurry of central bank activity this week, the Fed, the Bank of England, and the Swiss National Bank all scaled back their rate rises from 3/4 to half on Thursday. The Governing Council agreed to increase interest rates today and anticipates raising them further, according to the ECB, because inflation is still too high and is expected to remain over the 2% objective for an extended period of time. The 19 nations that utilize the euro had their inflation rate dip to 10% in November from 10.6% in October, the first decline since June 2021. Though high energy costs pose a risk of a European recession, ECB policymakers have stated that it is still too early to declare that the pace has peaked. A far way to go, according to Fed Chair Jerome Powell, to bring down U.S. inflation, which fell to 7.1% in November from 7.7% a month earlier. The stock market suffered as a result of investors receiving the message, "Not today," from central banks on Wednesday and Thursday. Investors had hoped for a break from dramatically rising borrowing prices. Following record rises of 0.75% in July and October, the ECB raised interest rates. Half-point increases are still larger than the typical movements prior to the current inflation eruption that was brought on by the pandemic's recovery and Russia's war in Ukraine, which drove up food and energy prices. The likelihood that inflation will continue above goal for some time, according to analysts at Pictet Wealth Management, means that Lagarde, at a minimum, should lean against the concept of a pause anytime soon. One justification for maintaining the firm anti-inflation message is that the prognosis for the European economy has improved, moving it from a potential calamity to a mere shallow recession. Despite energy costs increasing after Russia cut off most natural gas exports, the European Union succeeded in largely filling underground storage for the winter heating season. This has lessened worries about running out of gas, which is used for heating, industry, and the production of electricity, as well as worries about rolling power outages and industrial shutoffs. On the other hand, higher rates can limit economic growth, which has raised concerns in the United States and Europe. The slightly better, or at least less dire, picture for growth in the Eurozone is viewed as a sign that Lagarde and the ECB can continue to put inflation at the forefront of their minds. According to bank officials, taking severe measures now will stop inflation from becoming chronic and necessitating even more painful treatment. The benchmark rate for loans to banks at the ECB is 2%, and its rate on overnight deposits from commercial banks is 1.5%.